with Mr. Kevin Kelly joining me here at Hood Summit. Kelly Intelligence and Portfolio Managers, some very fun funds. I know you couldn't hear Brent there, but I'm going to just repeat what he said because I don't know how super plugged in you are like the market on the short term. I know you always are, Kevin, but he said basically the short dated flows kind of have us in a straitjacket. That is a good one.
Yeah.
To our own benefit, we just keep steadily grinding higher.
Yeah.
And 70% of volume last week was zero DTEs.
Yeah.
So tell me how that fits into what you're looking at, because you have funds that use zero DTEs. Connect that into the market, what's happening right now.
Yeah, and we've seen that this has been a long tailwind of using zero DTEs in portfolio management. I mean, we've seen it grow from 30% to 50%. Now we're up to 70%. Everybody's going short duration, right? The shortest duration they possibly can. And if there aren't zero DTEs, they're going into the weeklies, right? So if you look outside of zero DTEs, people are going to be using the weekly. So I would presume that actually the vast majority of what's left is those weeklies. And that's because volatility is the realized volatility has not hit the implied. So implied volatilities are still relatively elevated to the implied volatility. So that's why people are moving into shorter duration, because there's quicker moves and they're reacting faster. Think about tariffs. I mean, you couldn't even wait for the data to flow through on the economy or companies before we rebounded. Right. So I think the way to think about it is they're great risk management tools. And so,
which is the way you think about it, which is important because there's some people who think about it on the other end of that, right? There's a lot of people here who some of their biggest trades have been catching those moments where the realized vol catches up to implied, right? And they kind of surf. That's a lot of what Brent does. You're looking for, or how folks can use his data if they want. I know his personal trading, but you're watching, you're waiting, kind of trying to surf, catch a big wave. But what you're saying is that from an institutional standpoint, which is effectively more your role as an ETF manager, provider, et cetera, that you're using it because it completes the vol surface, and that you almost can't not use them if you want to be properly hedged.
Yeah, and I think the way to think about it is you can use them shorter duration and you can roll them so you're not using as much premium. And so what you can effectively do is use, especially zero DTEs on the put side, you can use them as a great tool to protect your portfolio. Say you're long a huge position in semis, right? AMD or NVIDIA or what have you. You can actually use zero DTEs on the downside and roll them for a little bit longer. And they actually serve better than these 3X products that are out there to the downside. So you have a lot of ETFs that are out there that can give you 3 times
the beta. You're talking about the pure beta stuff out there.
Yes, exactly. But then if you get caught on the wrong side, you have unlimited risk, right? But on zero DTEs, you have defined risk, and you can do that over multiple different days. So I think that's what the interesting aspect. And going back to catching kind of those big moves that you described, that's also risk management, because if you're only going to outlay a small portion on buying a zero DTE call, let's say, for example, and it doesn't hit, you only lose that premium that you paid, as opposed to being long just the beta or the stock or whatever it is. That could be a larger capital outlay. So you could have more of those, I guess you could say, bets or positions out there.
Now, this obviously gets right into product talk. Daily deltas, zero DTE, long options. This is attached to the NASDAQ 100. Ticker Q up and Q down.
Correct.
So this is talking to a similar a bit about what you're saying here, right? I mean, this is not, how does this kind of compare to the other fund we've talked about, that is the crypto funds, BITY and BAGY, to take the volatility of a very volatile asset and wring income from it? You're doing something similar with Q up and Q down with the zero DTEs, or what's kind of, how do those strategies differ from taking something and using options to generate?
That's a great question. That's a great question. So on Q up and Q down, all we're trying to do is have the zero DTE on to capture the market move as much as we can for that day, right? So we're trying to get leveraged returns on the upside or the downside. So you're leveraging your beta, but doing it through options premium, okay? But on the crypto funds that we have, on the Bitcoin funds, we're just trying to monetize volatility. We're getting that theta decay. So we're selling 5% out of the monies that are weeklies, and letting that decay over 5 days and capturing that options premium. So it's a little bit different.
So do you do any of the zero DTEs in the Bitcoin stuff?
No, we don't do any of that because on a on a 24-hour traded global asset, that we want to stay away from that, right? So
where does the
we're doing
clock
weeklies
start and begin?
Yeah, so Friday to Friday, right? So we're letting
easier.
that vol decay down over a week time period.
Well, that's what's kind of interesting, and because they're very different in that sense, but they're kind of taking different parts of the volatility spectrum, right? You're counting on the theta decay for the BITY and BAGY, but here in the zero DTE realm, in certain cases, you're comfortable owning premium. Right?
And that's all we're trying to do. So QUP and QDWN are trading tools, and so every day we're going to spend that options premium. And so the way to think about it is we're targeting about 4 times the amount of returns of that daily return for the Q. So if the Qs are up 1%, we're targeting and trying to get 4%, right? And if Qs go down 10%, we're only going to lose that options premium. So it's a risk management tool that we could own during volatile time periods or hedge for earnings events, and we're capturing the overnight. So we put it on at the close, and then we'll have it through the next day's close. So you will capture the overnight moves in the markets, because we see a lot of events
that happens overnight
and in the morning.
By the way, so last point here, which is we just had this conversation with Rob Baldwin from Trade PMR, custodian of $45 billion of advisor money that Robinhood bought earlier this year. And the idea is you've had, the way he put it, which is very much kind of the advisor, is, trading's kind of a young man's game, right? Or you've done so well, now time to get an advisor. My point was, all right, well, a lot of these people got to where they are because they were slinging options or doing something fairly active. Are they really going to then start buying buffer funds? I would guess what you might be able to pitch is like, hey, let me do a little bit of slinging for you. Is that kind of the idea?
Yeah, so the idea here is we're just trying to provide tools for portfolios, and so QUP and QDWN.
You buy and hold it.
No, QUP QDWN you do not buy and hold. You want to own it. They're because they reset daily, right? But here's why you use.
So they still got to do some slinging on their own.
Yeah,
this is just a tool to.
Well, here's the thing. They could be trading a bunch of the different names within the Qs that are going to move the market, but they can just set this on knowing that we're going to every day. So they could hold it for 5 days, 10 days, 30 days, knowing that they're going to have puts on and protect themselves or calls going up. So
they can freely trade their tech.
Yeah.
And they can have this little kind of hedge.
On the opposite side, right? Yeah. So say NVIDIA is going to report earnings, but they already own too much NVIDIA and they don't want to worry about it. What they can do is just own QUP, because it's going to move the Qs any which way, right? And especially for the Qs, think about it. Disruption is an ever-present, omnipotent phenomena that's there every day. So these are great tools for them, so they don't need to manage their options, positions, and margins or whatever. They know what they're getting with our products. For the Bitcoin products, right? BITY, BAGY, for them, it's just like, hey, let them scalp the premium. Let them do the professional options.
Passive.
I'll collect the options premium every month, and that's what I want to do.
Love it. Got a little something from everybody.
Yeah.
For everybody.
Yeah.
Appreciate Kevin. Always fun.
Thank you.
Innovative stuff. Always like the use of options and giving folks ideas, and hear people thinking about trading too, or taking something really volatile and getting income from it.